1973, Chicago, Fisher Black, and Myron Scholes publish a pricing formula for a European call option on a stock that pays no dividend. Traders had priced options by gut, tables, and rumor. The Journal of Political Economy prints the paper the same year the CBOE opens listed options. The tension is simple. Either the price is arbitrage-free, or it is a story. If you can build the payoff with stock and bonds, what must the option cost today? That one line on a trading screen now sits under trillions of dollars in listed and over-the-counter derivatives. Before listed options, contracts lived in back rooms. Dealers quoted whatever the customer would pay. Academic finance had random walks and portfolio theory, but it had no clean link from a stock's swings to a strike and a date. A European call is a simple contract. It gives the buyer the right to buy a stock at a fixed strike. The buyer can use that right only at expiry. If the stock ends above the strike, the call pays. If it ends below the strike, the call dies. In April 1973, the Chicago Board Options Exchange listed standardized calls. Fisher Black and Myron Scholes published their formula the same year in the Journal of Political Economy. Until that link landed, two market makers could mark the same listed strike dollars apart. Neither could point to a theorem. Spreads were wide because disagreement was honest. Practitioners used rules of thumb. Some used chart patterns. Some used crude shares of the stock price. Some used broker feel. Risk managers could not mark a book to one model. Two desks could mark the same inventory 20% apart. Both could claim they were conservative. This mattered beyond a trading pit. Pensions and endowments later held options inside funds. They also held option-like guarantees. A wrong mark is not a rounding error when the book is levered. It can hide loss. It can hide risk. It can make calm numbers look safe. The market needed a price tied to a trade. It did not need a story. The missing piece was a closed form. It had to link stock level, strike, calendar, borrow rate, and volatility. It had to return $1 price for a European call. What ingredients must sit inside any honest answer? Meet the players in plain clothes. S is the stock price today. K is the strike where the call pays off. T is the time left to expiry in years. R is the risk-free rate, compounded without breaks. That is the rate at which the model lets you borrow and lend. Sigma is annualized volatility of the stock's returns. It is the scale of the bell curve you believe in. N is the standard normal cumulative distribution. It turns z-scores into probabilities. Think of N as a dial. It answers one plain question. How much of the bell curve sits below this line? The model starts with a world that is clean. Stock returns wander at random. Their log returns form a bell curve. Stock prices then sit in a log normal world. They cannot fall below zero. They can climb without a hard ceiling. The call's value becomes a present value. It acts like a weighted coin flip. The weights do not come from a hunch. They come from that log normal world. They also come from a no free lunch rule. If one set of trades can copy the call must match that cost. That is the core idea. Do not ask what the option feels worth. Ask what portfolio copies it. Then price the portfolio. Where does the equation hide the replicating portfolio? Here is the Black-Scholes-Merton formula for a European call on a non-dividend stock. C equals S times N of D1 minus K times E to the minus R times T times N of D2. Here, C is the dollar price of the call option today. S is the current stock price. N is the standard normal cumulative distribution function, which turns a z-score into a left-tail probability. D1 is the standardized moneyness term that loads stock delta and the volatility adjustment. K is the strike price where the call finishes in the money. R is the continuously compounded risk-free rate. T is the time to expiry in years. E to the minus ER times T is the discount factor from expiry back to today. D2 is the standardized term used in the strike leg, linked to exercise chance under the risk-neutral measure. The promise of a price pinned by replication shows up as two terms. There is a long-weighted stock piece. That piece is S times N of D1. There is a short-weighted bond piece. That piece is K times E to the minus R times T times N of D2. The first term says how much stock the hedge behaves like. The second term says how much discounted strike money the hedge owes. The call price is the gap between them. It is not a mood, it is the cost of a live hedge. On day one of listed options, a market maker could use this. If the trader sold a call, the trader could hedge it. The hedge held N of D1 shares. The trader financed the hedge at rate R. That practice became known as delta hedging. Delta means the option's price change for a small move in the stock. Take a small sketch. Say N of D1 is 0.6. A trader short one call buys 0.6 shares. If the stock rises by $1, the stock hedge gains about 60 cents. That helps offset the short call. As the stock moves, the trader changes the share count. This is why the formula was not just a quote. It was a recipe. It told a desk how to trade risk through time. Why are there two D terms instead of one? Start with the thought Black and Scholes used. Model the stock as geometric Brownian motion. That means log returns are normal. It also means price levels are log normal. The stock can drift and shake. The shake is the random part. Now form a portfolio. Put the option on one side. Put the stock on the other. Add borrowing or lending. Choose the stock amount so the random shake cancels. For a tiny instant, the hedge has no stock risk. If it has no risk, it must earn the risk-free rate. If it earned more, traders would print money. If it earned less, traders would take the other side. That no free lunch step gives a partial differential equation. That phrase sounds large. It means a rule that links changes in option value to time and stock price. Solving that rule gives the formula. Now define the two hidden terms. D1 equals natural log of S over K plus open parenthesis R plus sigma squared over 2 close parenthesis times T, all divided by sigma times square root of T. Here, natural log of S over K is log-moneyness, or how far spot sits from strike in log space. Sigma is annualized volatility of the stock's returns. Square root of T is time scaling from Brownian scaling. Open parenthesis ER plus sigma squared over 2 close parenthesis times. T is the drift adjustment under the risk-neutral measure that pairs with log-normal stock moves. D2 equals D1 minus sigma times square root of T. Here, D1 is the standardized moneyness term we just met. Sigma is annualized volatility of the stock's returns. Square root of T is time scaling from Brownian scaling. If you stare at D1 and see probability jargon, you are close. Here is what changes. N of D, 2 lines up with the risk-neutral chance the call finishes in the money. N of D1 is the option's delta-weighted stock share in the hedge. Risk-neutral does not mean traders feel no fear. It means the model prices payoffs after shifting expected returns to the risk-free rate. That move lets the math focus on hedge cost. It does not need your forecast for the stock's true return. The extra sigma squared over 2 term has a job. It is the Jensen correction. That is a convexity tweak. The log of an average is not the average of logs. So the model pays a drift toll you do not see in plain means. The two D terms split 2 tasks. D1 serves the stock leg. D2 serves the strike leg. They sit 1 volatility step apart. That gap is sigma times square root of T. More time widens it. More volatility widens it. If the math pins a price, where does the real world first say no? The model assumes constant sigma. It assumes no jumps. It assumes no trading costs. It assumes you can trade without breaks. It assumes the stock pays no dividends. Each assumption is a crack. Constant sigma is the first crack. The model treats volatility like a number you plug in. Markets treat it like a price. It moves with fear, supply, demand, and balance sheet stress. It can change in minutes. No jumps is the second crack. Real stocks do not always glide. They gap on earnings. They gap on fraud. They gap on war. They gap when credit shuts. Continuous trading is the third crack. The hedge works best when you can rebalance all the time. Human desks cannot trade all the time. Even machines hit market closures. They also hit thin books. A hedge that works in smooth time can bleed in real time. Transaction costs form another crack. Every rebalance costs money. The formula has no bid-ask spread. It has no market impact. It has no broker fee. A desk that hedges every wiggle may pay away the edge. Dividends also matter. The clean formula here is for a stock that pays no dividend. Many stocks do pay dividends. Index options have their own dividend paths. Desks adjust the model for that. The clean line still teaches the core trade. Long-term capital management showed the danger in 1998. The fund had Nobel laureates on staff. It used models descended from this line of thought. It sized positions for smooth diffusion. Then correlations spiked. Jumps arrived. Liquidity vanished. Constant vol replication broke faster than desks could rebalance. The fund failed. The equation did not cause the failure. The gap between model world and market world did. The first problem was thin markets and wide spreads from disagreement. The formula does not remove disagreement when sigma is unknown. It does not remove disagreement when jumps dominate. It relocates the fight to the volatility input. Traders say the model is wrong but useful. They mean the shape is right. They also mean the parameters lie. So, what do practitioners actually do with it in 2026? The formula is not gospel. Inside the regime where diffusion roughly holds, it is the cleanest hedge ratio we have. And here is what you do with it. Traders invert the formula. They observe the market price C. Then they solve for sigma. That solved sigma is called implied volatility. It is the volatility number that makes the model match the market quote. This is a deep shift. The model starts by asking for volatility to get a price. The market turns around and gives a price to get volatility. Once desks quote implied volatility, they can compare options with different strikes. They can compare options with different expiry dates. They can see where fear sits. Implied vol maps across strikes and expiries into a surface. The surface is a grid. One axis is strike. One axis is expiry. The height is implied volatility. That surface stores crash fear, skew, and term structure. Skew means downside strikes often carry higher implied vol. Crash fear does not spread evenly. Term structure means short options and long options can price different worlds. A one-week option may fear earnings. A one-year option may fear rates, credit, and recession. Risk systems now stress that surface. They do not stress only one guess at sigma. They ask what happens if short-term vol jumps. They ask what happens if downside skew steepens. They ask what happens if liquidity cuts the hedge in half. The old formula sits inside that work. It is the first engine, not the whole car. Listed options on every major equity index run on engines descended from this 1973 line. Employee stock options have been expensed with model values. Convertible bond desks, structured products, and clearinghouse dashboards use the same family of tools. When regulators ask for a mark, they mean a model in this family. The shared public language from 1973 is met when two sides agree on inputs. It holds when they accept the diffusion approximation. It fails openly when liquidity vanishes. It fails when jumps rewrite the payoff overnight. So the trade lesson is plain. Do not treat sigma as a physical constant. Treat it as a market price. Ask who needs the hedge. Ask who cannot hold the risk. Ask what event the surface is trying to price. The next time you read an implied volatility, ask which expiry and strike it references. Then ask what jump or credit story that number is hiding. Treat sigma as a market price, not a physical constant. The Black-Scholes-Merton call value is the no arbitrage cost of dynamically replicating the option with stock and borrowing. The formula built the risk-neutral pricing layer that still runs listed, and OTC derivatives infrastructure, and the 1998 crisis showed how fast replication assumptions can snap. Tomorrow, quote any option in implied volatility, then ask what part of the surface would break your trade first.